All right, so we are recording now, and what I'm going to show you here is I've got three spreadsheets that I've prepared in different stages of development towards a final model for the DCF and the pro forma. So I'm going to call, the financials that we're creating are called pro formas, meaning that we're projecting out into the future what we think the income statement and the balance sheet are going to look like. And then we are going to also calculate the free cash flow to equity, which is unlike what your textbook says in chapter 6, where they're talking about free cash flow to the entire firm, we're going to actually calculate just to the equity so we can directly get the equity value. We won't have to subtract the debt off from that. And then that is going to give us a valuation, and that valuation is going to be called the DCF valuation, the discounted cash flow. It's kind of the big enchilada in terms of valuation techniques. You know, we looked at the dividend discount model, we looked at residual income model, we looked at that free cash flow model, we looked at relative valuations, but it's this DCF that really is kind of the all-encompassing model. And what I'm going to show you is actually kind of a baby version of that, the simpler version of it. You can have much more complexity in these models than what I'm going to be showing you here. Now, let's see. You know, actually, the other thing, in terms of the screen, is this, are you guys able to see the spreadsheet all right, or no? Not so much?
I can see, but it's a little bit blurry.
Okay, let me, one thing I could do, let me zoom in a little bit. Hopefully that's a
That's
bit better.
better. Yeah.
I was going to say the alternative is I could actually do a share screen. This is just my regular video feed. I don't think the resolution is going to be any different per se. And then also I can probably just get out of the way. You really don't need to see me. So let me just get out of here. How about now? Is that reasonably? And the most important thing that I want you to be able to see is like when I get into, you know, a cell, are you going to be able to see up here? Is that legible? Not really. And now when I zoom in, it's okay. Let me try one other thing. Let me try a share screen and see if that is any better. And oops, hang on a second here. How about that? Is that a better view for you all? I can only see a few of you shaking your heads, but that's preferable to what I was just showing you? Okay, we'll do the share screen then. Let me hang on just one second. Let me get readjusted here. And I'm going to stop the share for just a minute and get off of this, get myself back into the picture, and I'm going to close this. I've got my laptop open here. I'm going to get rid of that. All right, so we'll just work with the share screen. And I'm still going to need to open up two more of the spreadsheets here. Bear with me for just a moment. This is step 2. And where, let's see. All right. All right, going back to sharing screen, and I'm going to start here. Okay. So, this is the starting point. And what I have here is the 5 years. And so fiscal year 21, 2, 3, 4, and 5. This is the income statement. And this is the starting point here is having downloaded straight from Bloomberg and then changed all of these from formulas into values. And then I've got the same thing on another tab here. I've got the balance sheet, which actually has more years than I need, but later on I'll delete those. You'll see in the next spreadsheet that I delete those. And so that's where we start off. By the way, feel free to interject at any point in time, and if I don't see your hand raised, just unmute and shout out and say, hey, I've got a question about this, or could you go back, etc. So feel free to interrupt. The first thing to do here that I like to do when I'm working from Bloomberg data is that the amount of granularity that we have in these statements is actually not necessary for this pro forma exercise. If we were building a more robust model, if we had more data, we could use some of this additional detail, but a lot of it is unnecessary, and some of it is just repetitive. You'll notice, like here in row 6, we've got the revenue, and then down in row 7, we also have the revenue. So really, we can get rid of some of this stuff. So what I do is I typically go through and I start deleting columns. And so I've got cost of goods or cost of revenue, and then down below that, cost of goods and services. Again, that sub-account is unnecessary, so I like to go in and just delete that. And now we're down to gross profit. The other thing that you'll want to do here is, instead of having values in these subtotals, this is very important. Each of these steps is very important because you need it for all the subsequent things. But the first thing I'll do is, instead of having a value, I'll go in and change any of these subtotals into formulas. So this is going to be equals the revenue minus the cost of goods sold, enter, and then I'm just going to drag that across. And that takes care of the rest of them too. And I kind of keep an eye on the numbers just to make sure that numbers don't start changing. And, that usually indicates I've made a mistake somewhere. Many of these accounts have 0 or don't have anything at all in them, just dashes. And again, we can just delete those because those are unnecessary. Now, under operating expenses, so something like this, what I'll typically do is I'll look at this. We've got 3 sub-accounts here. We have SG&A, we have R&D, and we have other operating expenses. And what I typically do, part of the reason for having these 5 years of historical data, is it gives me a chance to kind of look things over and see what's happening with each of these accounts. And as I go through this, I see that it looks like operating expenses are going up on a fairly regular basis, not by a lot, some years more than others. And then when I get down into the detail, I see that for sure SG&A, that's by far and away the biggest of these accounts. So that's really driving this primary account. This particular sub-account is driving it. They have very little R&D, and that seems to be pretty stable. So it's, between 77 and 95 million per year. And then there's this other operating expenses. That's actually looks like a revenue, it's a cash inflow because it's a negative in an expense account. And that almost pretty much cancels out the R&D. And so I don't know exactly what's going on there. And again, if this were your job and this was the second or third time that you did a report on RPM, you would probably want to know the answer to what the heck is that other operating expense. For our purposes, though, I want you to focus on kind of the bigger stuff. You know, if we've got quarters, dimes, nickels, and pennies, this is probably one of those nickel or dime things, and I want you to focus on the quarters. So what I'm going to do is I'm going to make a decision here as to what to keep and what not to keep. I'm going to keep obviously the primary account, and I'm going to kind of view that as simply SG&A. The rest of it, I'm not going to worry about. So I've got 3 rows I can delete here. All right, so now we're down to operating income, which should simply be gross profit minus operating expenses. And so again, that's a subtotal, so I'm going to make that an actual subtotal, equals this minus the operating expenses, and then I'm just going to drag that across. And I'm done there. Next account, non-operating loss. Again, I look at the sub-accounts here and I see not a lot of change over time, not huge numbers in any of these accounts. And again, my point earlier about if we were doing this for the second or third time and you already understood the basics of security analysis reports, I would want to know what each of these accounts really meant. For our purposes, though, I'm going to say, well, we've got net interest expense, and actually this account is the sum account for these other 2. Those are sub-accounts to operating or to interest expense there. And then we've got other investments. We've got foreign exchange gains or losses, which actually that one's 0. So that one we can just dump right away. And then other non-operating income. And again, that looks like it's pretty much not much, not significant. So I'm just going to get rid of all of these sub-accounts as well. And so now I've got the primary account there, the non-operating loss, and I've got here's a subtotal. So again, I want to make that an actual subtotal. So that operating income minus non-operating income, and then I'm going to drag it across. So you get the idea. I'm fine-tuning this a little bit to my purposes. Down here, looks like we've got a bunch of things that are, one-off. So we've got M&A expenses. They've done some M&A, and it's not that that's unimportant. And in fact, the M&A is probably more important in terms of the growth of the company. But in terms of our pro forma, it doesn't amount to much. So let's not worry over these really small details. Legal settlement, restructuring, sale of investments, other abnormal. I'm going to keep the primary account up at the top, but I'm going to delete the rest of this stuff just to keep my life a little simpler. Then we're down to pre-tax gap, and again, that's a subtotal minus that. All right. So you get the idea there, and I'll show you the end result in the second spreadsheet here. Do you have any questions so far? Is this making some sense? Okay. All right, great. And we'll do the same thing with the balance sheet here. Now, obviously, I've got 1, 2, 3, 4, 5, 8 years. I'm actually going to delete these earlier 3 years. When I downloaded it, I just happened to grab 8. And I think actually I'd set it at 8 for the income statement because the income statement has projections, and those extra columns left me with, those were the projection columns, and then I switched over to the balance sheet and it still had 8. Again, am I worried about separating out cash equivalents, and short-term investments? And in fact, actually, short-term investments is 0, and the answer is no. So I'm going to delete both of those rows, and so on down the line. Am I worried about accounts receivable and notes receivable? Nope, because that one is 0. And again, so that I can delete those, et cetera, et cetera. Now, inventories, sometimes we might want to look at some of the detail on that, depending upon how the company is functioning. Raw materials versus work in process versus finished goods and so on might be important to us. If we see inventories climbing, that can be costly because essentially it's items sitting on a shelf somewhere and they're costing us money. We have to finance that inventory somehow. And if it's increasing a lot, say we've got a lot of finished goods sitting on the shelf, that could be a problem. So like here, this row here on finished goods, it looks like for a while they had some issues, or actually it looked like it was lower, and then it's come up. It's at 650 to about, well, staying around the 600 to 650 range. So another thing that I do as I look through these accounts, I go, aha, here's something that I might want to look into further. That seems like a substantial amount in a finished goods inventory. Is that normal? So I might make myself a little note that I might want to explore that a little bit later on. But in terms of our pro forma, I'm not going to worry about it. So here again, I'm going to delete these sub-accounts and then down to other short-term assets, and there's virtually nothing other than under miscellaneous. And so I'm going to get rid of those. And then, of course, the subtotal is, this is an important subtotal, this total current accounts, because, because that is going to be part of a calculation we need to do to get our net working capital. Now, one of the areas where we will keep the sub-accounts is under PPE, plant, property, and equipment. So this top account is the net. Then we have a sub-account of the gross PPE, and then the accumulated depreciation. So that's all of the depreciation that's occurred since the beginning of the corporation, right? So, and so we do want to keep that, partly because we're going to need depreciation for our calculation of free cash flow to equity. And depreciation, for some reason, on the way that Bloomberg constructs the income statement, it never shows up on the income statement. If you'll notice, coming back here, there wasn't a depreciation line in here. We didn't delete it. So I'm not sure why they do it that way, but that I happen to know that that's the way they formatted their thing. So I do know that I need depreciation. The only spot to get it is right here. Now, what I'm going to be doing later is that I want the annual depreciation. So if I wanted the depreciation for fiscal year 2022, I would take this figure, this 1,028.9, subtract the 1,002.3 from it, and that would tell me what my fiscal year 2022 depreciation was. So I'm going to hang on to those two sub-accounts as well as the net account. And in fact, what I'm going to do is I'm going to take the net account, and since it is also truly a subtotal, I'm going to actually write it that way. I'm going to write it this plus that. Minus that. Minus the accumulated depreciation. And I'm going to drag that across. Long-term investments, nothing there. So that can go. And then other long-term assets. Again, I want to look at this just a moment just to see if there's any clues in here as to something odd going on with the firm. I don't see anything in particular. They do have a lot of intangible assets, and they do have a lot of goodwill. And you remember, goodwill is the result of paying more than book value for a company that you may buy. And we know that they've done some M&A in the past. So this goodwill account is actually recognizing that for those previous mergers that they've done, or acquisitions, I should say. Other intangibles, again, significant. So I might make myself a note to, look into what these intangibles are. Um, what are we doing with them? What sort of income do they generate? But short of that, for our purposes here, I'm just going to delete all of these guys for our pro forma. And now we're down to total non-current, and again, that's a subtotal. So I'm going to make that, let's see, it's just that plus that. And there. And then this total assets is the subtotal of that plus that. All right. And you get the idea. Enough of that. You'll do the same thing down here on the liabilities and the equity side. You can get rid of a lot of things like these sub-accounts under payables and accruals. The other one thing I might do is look at these other payables and accruals. It looks like it's a sizable number. I might want to figure out what it is that they're doing there, but more than likely, those are just accrued taxes or something of that nature. Short-term borrowings, again, I can shorten that up considerably. One thing that I do notice is that we do have some short-term operating leases here, and then long-term debt. We've got long-term borrowings. We have long-term lease liabilities, as well as long-term operating leases. Again, kind of make myself a note that this might be something to look into. What are these leases? What are they doing with them? Why don't they just own the assets? That sort of thing. And likewise with other long-term liabilities. I won't bore you with actually doing this, though. I'll show you in the second spreadsheet. This will all be cleaned up, unless you've got specific questions. In equities, this preferred equity and hybrid capital, there's nothing there. Reason there are so many accounts with nothing there is that this is Bloomberg's format, and they superimpose the company onto their format, and many times their format, doesn't match up with the company. This share capital and additional paid-in capital, those two are going to be important accounts, but we really don't need the subtotals here, so those can go. Treasury stock is kind of a weird thing, but we'll leave it in there. That is actually, note the negative sign here. I don't know, did you see that just zoom in, or is that just on my screen? Did you see the zoom? You probably don't. Okay. I was going to, let me see if I can do that. Otherwise, I'll just use this then. Yeah, there we go. I'm sure you saw that. So notice here that this is a negative. Be careful when you do that subtotal. I'll mess you up if you don't recognize that as a negative. Equity before minority ownership, that's just a subtotal. We could actually, just add this minority ownership. It's trivial. Again, we don't even need this subtotal in here. We'll just total it up under total equity, and then we'll add together equity and liabilities, and obviously that should equal our total assets, 6253 with 6253. All right, so that's pretty much it. There's some other information down here that came along when I did the download out of Bloomberg. Some of it we're going to use. For instance, this shares outstanding we're going to use. And, some of the other figures are just helpful to know. Look at, we've got about 17,000 to 18,000 employees. Some ratios here that are helpful, but Other than that, that is the first spreadsheet. Now I'll move on to the next one here, unless you've got questions, or let me just stop a moment and see if there are questions.
I had a question.
Sure.
So, the spreadsheet we downloaded from Bloomberg says company in-depth fundamentals for our balance sheet.
Hmm.
Um, is that a problem or
No.
okay.
I think you'll find pretty much the same format. No, so it's not a problem.
Okay. Thank you.
But you'll want to go to the income statement and the balance sheet tabs, and I think I would put those. I think I would take those worksheets out of that fundamentals download and
Okay,
put them in a
because
new workbook, and then use that workbook to do your work.
we have KPIs, income statement, balance sheet, cash flows, multiples, and ratios. So I'll just take them out.
Wait, you have? I'm sorry. Say that again.
So we have from the download, we have KPIs, the income statement, which we need, the balance sheet, which we need, cash flows, multiples, and ratios
Yeah, and that, or you mean RPM, right?
for RPM. Yeah.
Okay, okay. Yeah, I mean, I would say, you could certainly work in that workbook, but depends on how you've already done the graphs and so forth. If you got everything in there, you could stay in there, because we're going to do all of the work that we're doing for this DCF on two sheets, so it won't take up too much of your workbook. It won't. The thing you want to try to avoid is having, a gazillion tabs down here at the
Right.
bottom. If you can keep it to a dozen or so worksheets, that's helpful.
Okay.
Any other questions before we go to the second one? Okay. And like I said, you can feel free to stop me um, if anything comes up. Hang on a second. Let me move this. And all right. Oops. Okay. Apparently that's only that sheet that it shared. So let me open this back up. I thought I was sharing the entire Excel, but obviously not. Hang on, I've got to move some things around on my screen so I can see what I'm doing. All right. Do adjust here. Okay, so here's that cleaned up income statement right here, all the way down to, there's my net income, right? So obviously I've done this in 11 rows. So I've really consolidated that income statement. And remember, the point is I want this to be as useful as possible without going into an immense amount of detail that we really don't have much knowledge about unless we get to know the company better. I've also started highlighting some things so that I can more easily see where things are. I've frozen the panel here so that, when I scroll down, I still have my headers, and when I scroll right, I still have my account information over there, so I know what's going on. So those are just kind of helpful things to do. And I'm sure all this freeze panel or freeze panes is right over here under Window, right? By the way, sorry, this is a Mac, so there may be some things that are a little bit different if you're a PC person. So the first thing that I've done that is of any substance is these three columns right here. And I do this partly because it's a cool little function, but mainly because I really I'm not sure exactly what's going on with these various accounts and how one relates to the other. And remember that this pro forma, we're using the percent of sales method predominantly. We're going to deviate from that a little bit. We're going to do some more detailed analysis of accounts, which is the other method. Um, in some areas, but most of it's going to be percent of sales. So obviously sales and revenue, same thing. So here, revenue is obviously 100% of revenue. But when we get down to cost of goods sold, we can see here that cost of goods sold is between 61 and 59% of revenue. Where these three columns differ is I've done with this one, I have averaged the cost of goods as a percent of revenue over all 5 years, over all 5 of these fiscal years. So that 61% relates all the way back to fiscal year 2021 up to 2025. And notice that, well, there's the formula right there. All right, simple enough. This column, I've just done the most recent 2 years. So I've just done 24 and 25. And it looks like they've done some work on the cost of goods sold. That's great. So again, more information. I'm gathering more information as I go here. And what you might want to do as well is jot some of this down so that when your teammates and you get together, they can actually, you can help share some of this information with them. So that's something that, I'd look at this and go, well, probably back in 22 or 23, somebody probably said, let's get our cost of goods sold down. And it looks like they've been quite successful at that. So again, this seems like a lot of detail or a lot of maybe unnecessary things, but one thing that I would do is to go back, and I'm not saying that you should do this for this particular one, this is kind of nitpicky, but what I would do is go back to those financials or to those 10Ks in that period and see what management was saying about cost of goods sold. Maybe they were saying, hey, we're trying to get it down, and now we see that they actually did, or is this just happenstance, right? The question is was this on purpose? Well, if it was, and they said that, then that's building some credibility for management. We're going, oh yeah, hey, managers are doing a great job. If it was just happenstance or maybe a change in product lines or something, that's a different story. But this might be informative. And then this final one over here in column J, this one is just the most recent fiscal year, 2025. And you'll notice that that doesn't change between the 2 years and the most recent. So that reduction in cost of goods sold must have occurred back somewhere in here. Gross profit as a percent of sales, operating expenses as a percent of sales, and you get the idea. We go all the way down here. We've got net income as a percent of sales. And again, notice this is the average of those 5 years, whereas over here, net income as a percent of sales has gone up. That's just the 2 years, and this is the most recent year. Any questions on that? Now, the other thing that you'll notice is right up above here, I have listed 1, 2, and 3 for those 3 columns. And I don't know if any of you have used this choose function. This is kind of a little add-on that I've put into this thing just to give me some flexibility. The choose function allows me to pick one of these 3 columns, when I'm over here in my pro forma. So these columns out here to the right, these are my projections. Notice that this fiscal year 26, 7, 8, 9, and 30. And so these are what I'm expecting it to be. And what I've done is I've used this, here's the choose function right up here. Is that legible on your screens? Some of you? Okay. So that choose function allows me to change which of these columns I use to calculate my projected cost of goods sold. So right now, I'm using column 2, which is the 2-year projection, or the 2-year percent of sales. And so this 44,919 is using that 59% of 75/20. So the 75/20, well, actually, let me back up just a minute too. Let me tell you about where this 75/20 comes from. Notice that the most recent revenue was 73.72. So what I'm doing is I am recognizing that over here, and then I'm growing it at my expected growth rate for revenue for fiscal year 2026. I've chosen to make that growth rate flexible where I can change it over these 5 years. You don't have to do that. You could use one growth rate and point everything to that. But it's very important that you have that growth rate somewhere where I can easily watch what happens when I change this to, say, 5%, and notice that the entire income statements all update. So when I want to change my assumptions, all I have to do is change one cell, everything updates. And what you would see on the balance sheet, the same thing happens. It'll change some of these figures as well. So you want everything linked back to just a few input cells like this. So these cells right here are really important. All right, now back to that choose function.
I have one quick question.
Yeah, go
Are
ahead.
those growth rates calculated, or did you just decide on 2%?
I just stuck a number in there so that we had something to work with.
Gotcha. Okay.
Yep, absolutely. So let me shift that back to 2. And so this choose function, basically it says, let's see, I2, H7, I7, and J7. So I2, notice, is this cell. H7, I7, and J7 are these cells. So the way you write this is you say here, this first thing right here, that is the cell that's going to tell Excel which column to choose. And then here are the 3 columns that I've written here, these columns 1, 2, and 3, for 5-year average, 2-year average, and the most recent year. And then what I do is I multiply the result. So in this case, I've got column 2, which is the 2-year average, is 59%. So it's going to take that 59% times cell K6, which is my revenue. And see how that works? Now, once I've written that formula, all I have to do is drag it right. Boom, everything updates. So that all you have to do is write it once and drag it across. You can actually, you can also notice how I've locked the columns and the rows strategically, right? So in the first one, I've locked both the column and the row with the dollar sign. Everybody's familiar with that, right? Okay. On the next 3, though, I've only locked the column, because when I copy down to here, I want it to adjust the row number. Notice how this is H9 and this is H7. So be careful how you lock these in. And also notice that I have locked in the row but not the column when it comes to the revenue stream too. So this operating expenses, it's still a percent of revenue. That's the K6 column. But I'm picking 28% as my percent of sales. And then again, when I've written this one, I can copy it all the way down, and then I can copy everything right, and I'm done. Now, the reason I'm not showing you that is that I've actually changed all of my subtotals to actual subtotals. So notice here that this is K6 minus K7. So it's revenue minus cost of goods sold. Don't make those percent of sales. The reason is that if you go back to change something in here, let's say that you go, well, wait a minute, I want to do something different with just cost of goods sold for fiscal year 2026. And I'm going to change that number to, I don't know, make it 3. Notice how the subtotal updates and everything below that updates as well. Well, if I hadn't written this as an actual subtotal, if I had done it as a percent of sales, gross profit as a percent of sales, it's 41%. It would stay the same regardless of what I did up here. Now, obviously, I don't want to do that, so I'm going to undo that change. So it's really important that you keep these subtotals actual subtotals. I've done the same thing here, down here. I just chose to, it looked like they had a fair amount of abnormal losses in here, and they seem to be regularly occurring. In this case, rather than actually do it as a percent of sales, I just picked a number that looked like it was an average of those 5 years, and I just carried it all the way through. So some of these things that we don't know exactly what they are, and they're not huge numbers anyway, so I'm not too worried about it. I'm just going to do it as a fixed value. Notice that this is a fixed value, not a formula. Income tax, we could calculate it using actual tax rates, but here again, I just chose to do it as a percent of sales and using this. Now, the other nice thing about this choose function is that if I should want to change it back to something else, like back to the 5-year average, all I have to do is change this one cell to number 1 and watch the income statement update. Everything updates. Obviously, the revenue stayed the same because the revenue is a result of these growth rates and the previous revenues. And if I wanted to go to the current year, I just change that to a 3, and I'm on my current year. And this also holds for the balance sheet. So the balance sheet has the same stuff going on it. Questions? All right, let's keep rolling on. Here's the balance sheet. And again, notice I've consolidated it like we talked about earlier. And then here are my averages. So what I did was I took the average. Now, remember, this is still as a percent of sales, not as a percent of assets. So our cash is running about 200 up to 300, and that is about 3% of sales. Notice that I had to go back to my income statement to get this figure. Pardon me. So when I wrote this formula, it gets, you're kind of bouncing back and forth between sheets. The good news, though, is that I only have to write it once. And as long as I lock in the right things up here using $, I can just, I can copy it down. And I just write the one row. All I have to do is write these first 3. And then I can highlight those and drag it down. And it takes care of the rest of them. Now, the other thing to note here is that I'm not doing all of the assets as a percent of sales. I'm simply doing all the current assets and the current liabilities right here. So those are the only ones that are as a percent of sales. And again, I use my color backgrounds to kind of help me see what's what and realize what's going on. Pardon me. All right. I've got some assumptions that I'm making up here. These are some of the inputs that I'm going to be using later on in the spreadsheet. And I like to put them up at the top where I can always see them, and I can easily change these. This particular one is how I expect plant, property, and equipment to increase. This is how I expect accumulated depreciation to change. And here is my other long-term assets. Up here is my leverage, my debt to equity, or sorry, debt to assets over here. And we'll be using those in just a minute. Now, so over here again, I've got that choose function. Ooh, that's not right. Well, let me fix that. Equal choose I7 ij and multiplied by. I'd copied some of this stuff from a prior spreadsheet, and that's why it's we were doing SJ or JM Schmuckers a few semesters ago, and that's what's messing me up here. So I think that will take care of that. Let's see what we get here. Oops, 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 oops. Doesn't like something. Oh, I know. I need that. There, I think that'll take care of it. There we go. All right, that's more like it. And then I'm going to need to K6. I need to copy this over. Boom. And down. Okay. Yeah. And again, notice how quick I was able to do all those cells. All I had to really do is to fix that one and everything, and then I just copy right, copy down, or fill right, fill down rather. And again, subtotals, so total current assets, it's a actual subtotal. And one thing to be careful, make sure that you leave out the subtotal accounts up above. This line right here, row 9, is the subtotal to rows 10 and 11. So I don't want to include that in this one. So point is try to be very detail oriented when you're doing this stuff. Now down here, long-term assets or non-current assets, there I'm going to make some different assumptions. I want to provide myself with some flexibility to be able to change these in a different way than as a percent of sales. And the reason being is that, as we talked about in class when we looked at, I think it was chapter 19 when we did pro formas, is that, depending upon whether a facility is at capacity or not, we may or may not need to add additional plant, property, and equipment to grow our sales. So here I've allowed myself the flexibility to change the PPE based upon an input cell right up here. Now I've chosen to do this only one. It only allows me to do one amount over the entire 5-year projection. Now, if you want more detail, you could put in a separate amount for each year. That's very easy to code in there as well. I just chose to do the one amount. And notice that what I'm doing here is I'm taking the prior plant, property, equipment over here. So that was the most recent actual, 3108.8. And I'm adding to it my assumed increase. And I've just, again, I pulled out of the air 400. So there's nothing to take away there. It's up to you as to what it is. And you really should be able to describe why it is you chose what you chose. But I'm just adding it there. And then again, over here, I go to the prior year, which again is 2026 now, and I add the 400. Be a little bit careful because these intervening columns, you have to write both of these separately, and then you can copy across. But if you try to copy across from here, it's going to give you a mess, right? Because it's actually looking back 4 columns over. So you don't do that. Likewise, on accumulated depreciation, my first projected year, I look back to the actual here in 2025, and I add to it the accumulated depreciation up in my input cell. And then again, this next one looks back to 2026, and then I can actually, I can just drag and and copy that over. And again, this is actually a subtotal. It is the gross PPE minus the accumulated depreciation. And then other long-term assets, I left some of the detail in there on the actuals, but I decided not to use it, at least at this point. So I'm just using, I'm using this, this 2761 net figure. And that's up here is, I'm just increasing it by 100. Again, number totally out of the air. What you might want to do is to look at historically what's happened with this figure. You know, it looks like it's been relatively stable. Recently it's gone up a little bit, but that looks like that was driven largely by a sizable increase in goodwill and then this other intangibles, which again makes me think, hey, I better look at that and try to figure out what's going on there. Make yourself a note so that later on you can go back and explore the 10K, some of the management discussion, earnings calls, and things like that, and see if you can figure out what's going on with those accounts, because those are fairly sizable. And then we go down here, we've got our total non-currents. Again, that's a subtotal. And then total assets is a subtotal of non-currents plus currents. So we've taken care of the asset side. And now we can move down to the liabilities and equity side. And I got that same mistake here. I'd copied things over, and for some reason the copy stuck in the path to this other spreadsheet that I was copying from. So fix that. Drag that guy across. Boom. And likewise, should be able to, well, let me just do it this way. Oops. All right, and that's a subtotal. Okay. Everything there is looking okay. Just want to make sure everything else is copacetic here. All right. So now here's where a lot of action happens in terms of formulas. Payables, short-term debt, those are just going to be percent of sales. And we've got that right here, right? And so those are fine. This is just a subtotal of the currents. And then we go down here to long-term debt. So when we start playing around with the spreadsheets, or when we start playing around with the financials, and we change our growth rates, we change the relation between various accounts, our balance sheet is going to fall out of balance. And we're going to need some external funds, right? Remember, again, back to chapter 19, that EFN, external funds, or I think external funds needed, I think was what they called it. Basically, what that's saying is that if my assets grow faster than my liabilities and equities, that means that I'm going to have to go out and issue some debt and or issue some additional equity. So we've got two accounts that we use to force a balance on the balance sheet. And we want to set this up so that those accounts will do it automatically without our intervention when we change the growth rate assumptions, which is going to change our balance sheet and ultimately throw it out of balance. And those two accounts are long-term debt and then this share capital and APIC, additional paid-in capital. And I've highlighted both of those in blue so that I know these are my plug, what they call plug accounts. Basically, they are going to force the balance sheet to balance. No matter what I do anywhere else, these two accounts will make sure that liabilities and equities is always equal to assets. Okay? So and the formula that you use here, think about it this way. We've got a portion of our assets are financed with liabilities, another portion financed with equities. In the case of this particular company, in the case of RPM, it is, hang on a second, I can't see that. I've got some of the Zoom stuff in the way. 62.88% of the asset base is financed with debt. In other words, notice where that formula comes from. I look back to the most recent actual year, and I take total liabilities divided by total assets. So 4889 divided by 7776, basically. So now I know what my capital structure is. We're going to have to make a decision here as to whether we keep the capital structure constant or we allow it to change. And what I found with most companies when we do this is that we're going to pretty much have to allow it to change a little bit, because if we don't, it typically ends up with a lot of equity being paid off, and or rather a lot of debt being paid off, and our equity blows up, and our leverage actually declines. So here's my advice to you when you're analyzing RPM. Look at what they've done over the years with regard to leverage. Is the company's leverage been fairly constant? In other words, same percent of debt to assets over the last 10 years? Has it been going down? Has it been going up? And not only looking at the historical actuals, but what does management say they want to do? You know, at 63% debt, you start to get a little bit worried about potential for bankruptcy, right? If the economy really goes south and we go into a deep recession, that's a lot of debt to finance, a lot of interest expenses. So my guess is that if you look at what management is saying, they might be wanting to bring down the leverage a little bit. And we can build that into our spreadsheet here. So right now what I've done is I've only built in the ability to keep the leverage at the same level for all 5 years. And that may not be a great assumption. This is one area where you might want to be more flexible and allow yourself to change leverage for each of the 5 years. And that would allow you to better reflect in your financials what management is actually doing. Okay? So how do we actually code this in Excel? It's pretty easy, but you do have to be a little bit careful. So here is my plug figure for long-term debt on the liability side. I'm just going to hit this and I'll show you where all these cells are. So what I do here is I take Q1 times K25. So Q1 is over here. It's the last year's debt to assets. So let's just call it 63% for discussion's sake. So I'm taking 63% of K25, and K25 is the current year's total assets. So I want my liabilities, my total liabilities, I want them to equal 63% of total assets. So that's what I have to start this formula out. Now, long-term debt is not the only liability. I've got short-term liabilities and I've got other long-term debt. So I want to subtract off K30 and K32 right up here. So K30 is total current liabilities and K32 is other long-term liabilities. Those are the only other two liability accounts on the liability side of the balance sheet. So when I've done that, notice that this 5,078.3, that's going to be exactly 62.88% of 8,077. I can do that. I can check that just by saying this, divide by this, And lo and behold, let's add some. There's value 62.88%, right? So that's my plug figure for liabilities, and that's going to give me a total liabilities of this. Now, I still need a plug figure for the equities because remember on equities, I'm adding retained earnings down here, and that's increasing as time goes by. And so I want this figure right here, this total equity, to be 37% of assets, 1 minus the 63, right? So, and my plug figure is going to be the share capital and APIC. And again, you'll notice up here, the same sort of formula, except instead of Q1, I have 1 minus Q1 times K25. Again, that's my total assets for the current year. And then I'm going to subtract from it all of the other equity accounts. The only little quirk here is that a couple of my equity accounts, I think it's, or maybe it's just one. Yeah, it's just the treasury is a negative. So instead of subtracting that treasury account value, I'm actually adding it. So you'll notice here I've got plus K38. Well, K38, that's my treasury. And then the others, K39, 40, and 41. K39 is retained earnings, 40 is other equity, and 41 is minority and non-controlling interest. So I've subtracted off all of the other accounts, and so my result is that share capital and APIC is 898.6. And here's the thing to notice is that it's dropped a lot. So in other words, we've more or less bought back equity, or at least that's what our spreadsheet is telling us. Now, if I were to change my assumption about debt to assets, let's say I were to change that to, let's make it 50% instead. I'm going to put 0.5. Notice what happens there. All of a sudden, oh, I've got too much equity. You know, that's a huge increase. So effectively, remember, these are just plug figures, but when I put this back into the real world, what does this really mean? Well, it means that I just issued a whole bunch of equity because I went from 1179 up to 1938. So that's probably not what they're actually going to do. I wonder what happens if I just do like 60%. Ah, okay, I get something a little more reasonable. So, you know, play around with this and try to figure out what it is that RPM is actually going to do in the future with their debt to asset or their leverage ratio. That's the real goal. And what you want to do is you want your statements to reflect that as closely as possible. Okay. Okay, so we got plug figures. I've got one other thing here, and that is that retained earnings. Notice that historically, retained earnings started off in 21 at 1852, and by the time we got to 25, we were all the way up to almost 3,200. And that's because anything that doesn't get paid out of net income as a dividend gets moved to the balance sheet and becomes part of retained earnings. So this is accumulated earnings that is owed to the shareholders. You can think of it that way. And so over here, what I've done is I've taken the prior year's retained earnings, the 2025, and I've added to it off of the income statement, I've added cell K17. Well, let's go see what K17 is. K17, here's K, and here is 17. So I'm right there. Now that is what's left over after I paid out my dividend. Something I didn't mention when we were over here on this income statement is that after I get down to my net income, I actually subtract off an amount that is my dividend. And I actually do that, I've got it down here simply because that's where you'll notice they've got dividends per share and total cash dividends already in here, historical. So you've got, here's your dividend per share, and then here's the aggregate over here. So that's why I left it down here. You don't have to. You could move it up if you wanted to. But so I made an assumption that it looks like they increase their dividend about 7% each year, thereabouts. So I just built that in. And again, don't take my word for it. I want you. You're the analyst. You decide what they're going to do. Maybe management is actually telling you if you listen to the earnings call or something, but I want you to figure that out. So here what I did was I took the prior years, the most recent, the $1.99, and I increased it by 7%. I did the same thing for the next year and so on. So I've got my per share dividend right here, $2.13. And then over here, what I did was I took it times the total shares outstanding. And here's my shares outstanding, 128 million shares outstanding. All right. So now that's my figure that gets paid out as a dividend. So 273, notice what cell that is. That is in K44. Well, notice that up here, I subtract from K16, I subtract K44. So what's left over, that's my retained earnings, and that goes onto the balance sheet. All right. We're at a good stopping point. I'm going to shift over to the third and final spreadsheet, but let me stop and see if there are any questions. Everybody's good? All right. We'll keep rolling. We should be able to wrap this up by 7:30. So if you've got anything going on, feel free if you need to leave, but it won't be too much longer. Let's see. Let me close this one out. And I'll reshare the third one. All right, so I have everything that we had on that second spreadsheet, and what I've done is I've added to this, and you could do this either on the income statement or on the balance sheet. In some regards, I almost wish I had done it on the balance sheet because there's less bouncing around between two different sheets. But this area right here is what we're going to focus on next, and this is the kind of the final step in the whole process. What I'm doing here is I'm calculating my free cash flow to equity. I'm calculating a terminal value. I'm getting the present value of all of those things. I'm adding it up, and then I'm dividing that aggregate firm value by the number of shares outstanding, and ultimately down here, I'm getting a price per share. And that is the DCF. All right. Now, how did I get this formula and so forth? Let me show you. Let me go to a website. Hang on just one second. I meant to bring this up and I forgot to do it. Let's see. Let me stop sharing a second. I'm just going to share my screen. It's easier when I'm just moving around. All right, so I think it's over here. Yeah, I believe it's on this document. These FAQs are, one spot to look if you're unsure of what to do next. There's probably an FAQ. It's this link right here. It's this wallstreetmojo.com, free cash flow to equity. And I'm just going to copy that. I don't think the link is going to click right for me. And we'll just go over there. All right. And so what this particular page does is in fact, this whole website is really well done. I recommend it in terms of if you have questions about anything finance, corporate finance related. Most of these things are done by very highly qualified people. Most of them are CFA charter holders and that sort of thing. So you can really count on this material as being high quality. So this particular page actually walks you all the way through how to calculate free cash flow to equity, and it even has a spreadsheet example. And so let me get down here to, they start with a bunch of introductory material, but we get down here to the formula itself. And here we are. So right here, oops, this guy right here, there's our formula. So to get free cash flow to equity, we start with net income. We add back depreciation. We add back changes to net working capital, which usually is a subtraction because it's an increase we subtract, decrease we add back. And then we add or subtract the CapEx. Most of the times we're increasing CapEx, so it's a subtraction. And then net borrowings, if we increase the amount of borrowings, in other words, if our debt goes up, then that's a positive. If debt gets paid off, that's a negative. So keep your signs, be careful of your signs. And they'll go into more detail down here on each of these items. So like I just mentioned, working capital can be a positive or a negative depending on which way it's moving. CapEx can actually be either one. Usually it's negative though. And the same thing with net borrowings. They also show you some alternative formulas. So you can start at various spots. Here, they're actually saying you could start at EBIT, subtract off interest, taxes, depreciation, net working capital, CapEx. But so there's a lot of flexibility and a lot of great information in here. Now, here they actually show you a spreadsheet similar to what we're working with, an income statement and a balance sheet. Notice though that their most recent year is over on the left as opposed to mine is over on the right. But then they'll actually show you the formula. So if you wanted to figure out how to calculate changes in net working capital, you can do it right here. So this is a great resource, and I strongly recommend that you read through this carefully and take it all in. They also talk about terminal value right here and so on. All right, so let's get back to our spreadsheet. So this came, I used their formula. And so we're starting, in our case, with net income. And that's an easy one to grab because it's right up here, right? So I'm just grabbing that. And again, I'm using a formula. I like to use formulas. Hard code as little as possible into your spreadsheet. The moment you start hard coding, if you want to make changes, it mucks things up. It makes your life so much more difficult. And spreadsheets are great because it does give us so much flexibility. So here's my net income all the way across. Then I've got depreciation. Now depreciation, I calculate off of my balance sheet. Like I said earlier, it's the current accumulated depreciation minus the prior year's accumulated depreciation. And so here you'll notice that I've just got that up here on the balance sheet. I'm just taking K16, subtract G16 from that. So K16 is my 2026 depreciation accumulated, and G16 is my 2025 accumulated. And you'll notice that this happens to be 130. Well, it's 130 because that's what I forced it to be. Remember that input figure up here, right over here? There's where that one's so some of these things you'll know that your formula is right or wrong, because if it doesn't match my input, I did something wrong in the formula. I would recommend, though, not jumping in there and going to the 130 and the input. I would recommend actually calculating it off the balance sheet. Change in net working capital. That one is a little more complicated, because what we want to do is we want to take the current assets minus the current liabilities of the current year, subtract from that the current assets minus the current liabilities of the prior year. Usually that's going up. And so that is, we're ultimately going to subtract this value out when we do our summation. CapEx, same thing. Again, why is it 400 in all 5 years? Because I forced it to be that way. And yet I am actually calculating it off of my actual balance sheet. I'm not going up to that input formula. And then finally, net borrowing is actually the sum of long-term debt and short-term debt. And it's the difference in the sum of long-term debt, short-term debt for the current year minus the long-term debt plus short-term debt from the prior year. So make sure that you do that properly as well. Otherwise, you'll get some crazy figures. Then all we have to do is plug and chug. So I've referenced all of these, and I've made my negative for the NWC and for CapEx. Everything else is a positive. And I've got a free cash flow to equity for fiscal year 2026 of 552. And then it goes up, and there are the other 4 years. Next line down, I've simply taken the present value of it, and notice that I've kind of, sorry, I thought I heard somebody say something. I've set up my little grid here so that I can easily do that present value. Notice I use that 5 for the exponent. That 018 up here is the exponent. My K26 is my discount rate. There's my K. And again, if somebody else is calculating the K for your team and you don't have it yet, just plug in a number, and you can always change it later. And that's why it's only in one spot here. So I've got the discounted value of all of my cash flows. Now I just need one more thing, and that is, what is the firm worth after the end of 2030? 2 ways to go about that. One, you could use dividend discount model or a residual income model. The second way is you could use a relative valuation, like the PE ratio. Here I actually chose to use the dividend discount model, and you'll notice here I've taken the most recent dividend, that's the 044. So if you go down here, you'll see 044, that's the current aggregate dividend, 358. And I have taken that and I have grown it at, and up here I've got an input figure for the terminal growth, for the terminal growth rate of 3%. I did it as an input so that I could easily change that if I wanted to. So I've grown it at 3%, and then I divide by K minus G. So K26, there's my K right there, 11%. And M1, again, is my growth rate, 3%. And so I have a terminal value. So the company after 2030 is worth 4609. Another thing to note here, this happens with every analyst report, especially with a 5-year as opposed to a 10-year. The vast majority of the firm value derives from this figure right here. And so we have to be somewhat careful about, we have to be very conservative, I would say, with our estimates of this, because it can blow things up. And so we've done all of this great work, and to have most of it weighted on this, it doesn't make a lot of sense, but that's the way it is. So down here, what I've done is I've just made this my annual discounted value. So I have, let's see, I have discounted. Did I discount that already? Da-da-da-da. Oops, 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 oops. Huh. I've got a mistake here. I need to discount this. I need to discount my terminal value. I didn't do that. I just simply added it up. And so let me fix that. That's pretty easily fixed. I'm going to discount that by my 11% figure for 5 years. So let's see, let's divide this whole thing by 1 plus RK raised to the 5th power. That's better. All right. Sorry, I should have caught that before. All right, so now that's my discounted terminal value. And now here's the sum of the discounted terminal value plus that last free cash flow. And then here are the other free cash flows. Here I've simply added them all up. And then this last formula, I'm just taking the aggregate discounted cash flows and I'm dividing by the number of shares outstanding, which is right down here. So when this formula is aggregate DCF divided by total shares out. Watch your units there. It's easy to get weird looking numbers if you're not careful about your units, but both the aggregate DCF and the shares outstanding are both in, I believe they're both in millions. So I don't have to do any adjustments to either one. And that's it. I was pretty close, 1 hour and 24 minutes, not an hour and a half. Questions, comments? What do y'all think? You ready to do this?
Professor, will you be uploading the recording right after this too, to kind of be
I
able to
will.
go?
Absolutely.
Okay, thank you.
Yep. Sure. Yeah, so you can go back through and stop and look at formulas. What I won't do is I won't upload the spreadsheets. I know it's a bit tedious. It'll probably be the last time you'll ever have to do this. You'll probably be working, if you're an analyst, you'll be a junior analyst working with a senior analyst, and they'll probably already have a spreadsheet built, and it'll be up to you to start plugging things in. But this experience at least gives you some sort of flavor for what it takes to build one of these animals. And it improves, hopefully it improves your Excel skills a little bit too. Anything else? I'll stop sharing. And all right. Well, thank you all for sticking it out for the entire 1 hour and 25 minutes. And I will see you all tomorrow afternoon in class. And I'll get this uploaded. Actually, it already is up on the web. I saved it to the web. And I'll just, I guess I can send the link out in an announcement. It'll be the easiest way to get there. You all have a good evening.
Thank you.
Bye-bye.